Charleston has the highest vacancy at 20%, followed by Austin at 16% and Phoenix
Wow.
at 12%.
Okay.
So strong
Those
new
are
supply in
big,
these
yeah.
markets. Yeah, strong new supply in these markets has resulted in vacancy climbing quickly. It's up over 400 basis points year over year in several of them, although even that climb has started to slow in each market, which is good news.
Wow, those are some crazy vacancy rates.
All right, welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor. We have a great guest today, Craig Hurvitz, who is our National Director of Research for Industrial and does a fantastic job and is always very helpful for our clients and investors of the like. So, Craig, thank you for joining us again. I think this is your second time joining us on the podcast. Thank you.
Yeah, thanks again for having me. Always happy to join.
Yeah, so let's jump into it. I mean, lots going on in the industrial space, in the industrial world. Why don't we start with just kind of a high level 2024 recap on the industrial occupier side? Let's start there.
Yeah, sure. So bulk occupancies, which we consider to be 100,000 square feet and up, they were up a bit in 2024 compared to 2023, which is great news for the market, but they were still well below the record activity that the market witnessed back in 21 and 22. The number of new occupancies, 100K and up, was up about 11%, although the average size was down about 9% to 264,000 square feet. More tenants moved in, but they were smaller in size on average. Occupancies 500,000 square feet and up were down, with those 750,000 square feet and larger dropping by 26% year over year. The largest increase was in the 300 to 500,000 square foot range. That was up 23%. 2024. Leasing activity picked up in the second half of 2024, and that signals another uptick in 2025 as those tenants take occupancy of the space that they've recently leased.
Yeah, and let's talk about what sectors of tenants are hot and what sectors are not. I'm noticing a lot of 3PLs giving back space. Is that, at least in our local market, is that happening nationally? And what sectors are on the move?
Well, actually, in 2024, as far as who is leasing this bulk space, 3PL providers and transportation companies dominated. They accounted for 33% of that bulk occupancy activity, or about 101 million square feet of it. Asian-based 3PLs accounted for 27% of the 3PL activity. That was a big bump from 2023.
Yeah.
And in a few markets, Philadelphia, Savannah, Austin, and Greater Los Angeles, these Asian-based 3PLs accounted for more than 40% of the new occupancies in this category during the year.
Why do you think that is?
You have these Asian-based 3PLs that really want to get a footprint in terms of their industrial inventory here in the United States. A little bit less is coming from China, so they really want to get a presence here in the States.
Interesting. Yeah.
Yeah, we were on a call with one of our Southern California experts the other day, and he said that 75% of the activity in Southern California and the Inland Empire was Asian-based 3PL companies at that time. So
that's pretty consistent with what I'm finding. Yep.
Yeah. So big uptick there. Vacancy rate went up in 2024 compared to where we've been over the last few years. So can you talk a little bit about what the vacancy rate did in 2024, and then were there certain markets that were outliers, within that performed better than others?
Record new supply has pushed the U.S. vacancy rate up over the past 9 quarters. It reached a low of about 3.6% in late 2022, and now it's up to about 6.8% at the end of 2024. While that's the highest rate that we've seen since 2013, it's only 50 basis points above the 15-year average of 6.3. Vacancy was much higher back in 2010. It peaked at 9.3%. Now, not every region or market is the same story. Vacancy is highest in the South region, where the most new supply has been delivered, at 8%, and it's lowest in the Midwest at 5.3%, well below the national average. It's increasing the fastest in the West region, where it's up 220 basis points year over year to 7%. But the good news is that as construction deliveries continue to fall off every quarter, the pace at which vacancy is increasing has slowed dramatically. Now, vacancy is highest in the emerging or secondary markets that have added the most new supply over the past few years. Those markets include Savannah, which has increased their industrial inventory by 73% since 2020. And Charleston, their industrial inventory is up 50%. Austin also up 50%, and Phoenix up 37%.
What's the vacancy in Savannah?
Savannah, I think it's closer to 14%.
Okay. Is that the highest of kind of the industrial markets that are non-tertiary?
Well, Phoenix is up to about 12%, so that's right there as well.
Okay.
So those markets are also seeing some of the highest vacancy rates in the country, well into the double digits. Charleston has the highest vacancy at 20%, followed by Austin at 16% and Phoenix at 12%.
Okay.
So strong new supply in these markets. Yeah. Strong new supply in these markets has resulted in vacancy climbing quickly. It's up over 400 basis points year over year in several of them, although even that climb has started to slow in each market, which is good news.
Wow, those are some crazy vacancy rates. And I hear that Phoenix is going to jump again because they still have a lot of pipeline of construction going on right now, right?
Yeah, they still do. So it's poised to head even higher, and it'll take Phoenix a little longer to recover than some of the markets where vacancies consistent with the US average or a little bit below.
I'm curious, going back to like what sectors are hot. We're hearing a lot about bringing manufacturing back. Are you seeing it? And if so, where?
We're seeing it. There's a lot of projects, especially advanced manufacturing projects that are actively under construction throughout the country, especially in the South, the Midwest, and portions of the West. Those projects will deliver in 2025 and 2026. And when those projects deliver, that'll have a positive impact on net absorption and occupancies. So we're a little ways out from seeing that activity impact the statistics. But once it does, we'll see manufacturers represent a larger percentage of those occupancies.
Thank you for that, Craig. And tell us a little bit about development. You've touched on it, but where are, the majority of projects in 2025? Where's all the construction going? And maybe nationally, compared to COVID, what are we down percentage-wise?
Yeah, sure. So at the end of 2024, 295 million square feet was under construction nationally. So that's down 60% from the peak of 711 million square feet in the middle of 2022. The current pace of development is in line with how much space developers were building pre-pandemic back in 2018 and 2019. And with construction starts expected to remain low through most of 2025, that pipeline will decrease even further, and this is great news for the market. The most space is under construction in the South, and that's been the case for the last several quarters. But again, in each region of the market, that pipeline is decreasing and has decreased significantly. From its peak in each region, it's off anywhere between 55 and 65%. Now, build-to-suit development has played a more significant role as spec construction continues to fall off. In some markets, build-to-suit activity has surpassed spec. For example, of the 12 million square feet under construction in Chicago, 83% is build-to-suit. Now, just a year ago, it leaned towards spec development, accounting for 62% of active construction. Looking forward, I expect construction activity to bottom around the end of 2025. Then we'll gradually see it increase again as the next development cycle begins.
Let's talk a little bit about port activity. The major ports, where are we on overall volumes? And then my second part of that question, right before the podcast, we talked about the news today on the tariffs with Mexico and Canada being delayed. You said until April 1st, correct? That news just came out?
It's still early April, I think.
Early April. So maybe on a second part of that question would touch base a little bit on that. And I know you can't crystal ball it, but if those tariffs go into effect, maybe how does that affect port activity?
So the good news is, and we just put out our annual Seaport Outlook just earlier this week. So you can really dig into the weeds if you'd like to. But the good news is that container volume rebounded during 2024. It increased 12% year over year to more than 53 million TEUs. And that's across the country's 12 largest seaports. That's what we report on in that report. This figure was just shy of the record 54 million TEUs in 21 and 22.
Wow.
This increase was consistent in nearly every port, despite all those numerous disruptions that we experienced, including port strikes, the Key Bridge collapse, hurricanes, geopolitical tensions in the Red Sea, the drought that was impacting the Panama Canal, and as you just mentioned, the proposed tariffs leading to cargo delays, supply chain disruptions, higher costs, and inflation. The rebound in port volume should translate to an uptick in demand, especially industrial demand in nearby markets. And each of the ports are investing in infrastructure and innovations to improve capacity and operational efficiency, which can only be a boon to the industrial markets and industrial activity overall. Now, it's hard to say exactly how things are going to transpire with these tariffs, the impact it'll have on the ports, the impact it'll have on the individual markets that sit near those ports. There was a big increase in container volume, especially in the second half of 2024. We can attribute some of that to stockpiling or bringing in additional TEUs from especially China in advance of those proposed tariffs. I think we'll continue to see strong port activity in 2025, despite these tariffs and how they might evolve as the year goes along. And again, any uptick or any increase in port activity will have a positive impact on the industrial market.
That's really interesting that we're at just below, say, COVID, which were record levels of port activity. We're just below that, but the vacancy rate is skyrocketing with all that import coming in. And to your point, people maybe trying to backstock stuff. I would think we would not have these dramatic hops in vacancy with that. So that's interesting. Where's the product going?
It's going. It's going, and there's leases being signed, but really those upticks in vacancy are just related to that record new supply that's come online through construction deliveries.
Good point.
The great news is that construction pipeline has dramatically decreased. If we were to continue building at the pace that we were in 2022 and into 2023, vacancies would be climbing a lot more quickly, and they would peak at much higher levels than they are.
Yeah, no, that's definitely good news on that port activity, because as we know, that is a good sign for the industrial market. So as you kind of look in the crystal ball for 2025, do you have any predictions on what's going to play out on the occupancy side, and then how that's going to impact the vacancy rate moving forward as well?
Yeah, sure. Occupier demand remains the wild card in the equation. It's easy to forecast new supply and its impact on vacancy, both nationally and market by market. I capture data from every market in terms of their industrial pipeline, how much of it is spec. And, based on those numbers, I can say, here's where vacancy is going to peak, based on historical demand. But there's so many things happening in our world right now that demand remains that wild card. The good news is that demand looks to have bottomed in 2023. We saw a bump in 2024. And leasing activity, especially in the second half of 24, shows hopeful signs for another increase in 2025. Hopefully, uncertainty will fade with time and result in pent-up demand, especially in certain industries that have been more cautious than others. Now, as new supply bottoms during the second half of 25, I still expect supply and demand to return to balance at some point this year, resulting in vacancy peaking just above 7%. And as I mentioned, it's great news that we're not building at the pace that we were just a year or two ago, because vacancy would climb much higher. Now, in some markets, vacancy will climb faster and peak higher, where construction activity still remains strong. It will take those markets longer to recover than others. And after peaking later this year, vacancy will start to decrease again, although it will likely be a gradual decline instead of an abrupt drop.
Yeah.
Well, Craig, this was awesome information. I think this is your second time on the show, and you're a wealth of awesome information, and we greatly appreciate you being on the show for a second time. Thanks a lot.
Yeah, Craig, thank you, and great job, as always.
All right. Thanks a lot, guys.
Appreciate it.
Thank you very much.